Another day, another story. Today, we're going to talk about two important topics in finance: cost of capital and capital structure. The cost of capital is the weighted average cost of resources, taking into account the interest rate on debt and the return on equity. These are important for anyone who wants to understand how businesses raise and allocate funds to finance their operations and investments. Let's start by defining and understanding some key terms. Cost of capital refers to the cost of the funds that a company uses to finance its operations and investments. The cost of debt is usually lower than the cost of equity because debt is considered less risky than equity. As a company takes on more debt, the cost of debt increases due to the increased risk of default. On the other hand, the cost of equity increases as a company becomes riskier and less attractive to investors. It includes both debt and equity financing, and it's important because it influences the company's investment decisions and profitability. Capital structure, on the other hand, refers to the way a company finances its operations and investments by combining different sources of funds, such as debt and equity. The goal of capital structure is to find the optimal mix of financing that minimizes the cost of capital and maximizes the value of the company. Now let's take a closer look at how they work in practice. When a company needs to raise funds, it has two main options. It can issue debt or equity. Debt is a loan that the company must repay with interest, while equity is ownership in the company that gives investors a share of its profits. Each of these sources of financing bear some cost. The cost of debt is the interest rate that the company pays on its loans, while the cost of equity is the return that investors expect to earn on their investment. The cost of equity is usually higher than the cost of debt because investors demand a higher return to compensate for the higher risk of investing in stocks. So, how does a company decide how much debt and equity to use in its capital structure? The answer depends on a number of factors, including the company's risk profile, the current market conditions, and the availability of financing. The WACC is the average cost of all the funds a company uses to finance its operations. It's a critical measure because it represents the minimum return a company must earn on its investments to satisfy its investors. WACC stands for Weighted Average Cost of Capital, which is a financial metric that calculates the average cost of a company's capital, which includes both debt and equity. The WACC formula takes into account the proportion of debt and equity in a company's capital structure, as well as the cost of each source of capital. The cost of debt is calculated based on the interest rate a company pays on its outstanding debt, while the cost of equity is calculated based on the return required by investors for investing in the company's stock. In simpler terms, WACC represents the minimum return a company needs to earn on its investments in order to satisfy its investors and lenders. It's a critical measure for evaluating a company's financial performance and its ability to generate returns for its stakeholders. Company finances its assets through a mix of debt and equity. Its capital structure affects its risk and return, which in turn impacts its cost of capital. A company with a high level of debt in its capital structure is considered more risky because it has more financial obligations to meet. As a result, it has a higher cost of capital. Conversely, a company with a high level of equity is considered less risky and has a lower cost of capital. The goal of a company's capital structure is to balance the benefits of debt and equity while minimizing the risks. It's like a seesaw. Too much debt can tip the company over, but too much equity can also be unbalanced. One key concept in capital structure is the idea of leverage. Leverage refers to the amount of debt that a company uses to finance its operations and investments. A company with high leverage has a lot of debt relative to its equity, while a company with low leverage has more equity than debt. The level of leverage a company chooses can have a significant impact on its cost of capital and profitability. A company with high leverage may have a lower cost of capital because debt is generally cheaper than equity, but it also faces higher financial risk if it can't meet its debt obligations. And a company with low leverage may have a higher cost of capital because equity is more expensive, but it also has less financial risk. Remember, the goal of capital structure is to find the optimal mix of financing that minimizes the cost of capital and maximizes the value of the company. Thanks for watching.